Yeah, geopolitical tensions are always something markets watch closely. And the recent escalation in the Middle East could introduce short-term volatility, mainly through movement in oil prices and shift in investor sentiment. We are monitoring how the Iran conflict develops and whether there are developments around the controls of the Strait of Hormuz, as that will ultimately dictate the direction of oil prices and the broader market reaction. That said, for long-term investors, geopolitical volatility is often more noise than trend, and these periods can create opportunities to accumulate quality assets at more attractive valuations. Our approach is disciplined and adaptive because we see global markets entering a period of structural transition. Today's environment is shaped by geopolitical realignments, supply chain shift, and rapid technological investment. Rather than chasing short-term noise, we focus on long-term structural winners. Within equities, we are overweight 5 sectors: technology, energy, healthcare, building materials, and utilities. These sectors are supported by 4 key themes: the AI infrastructure supercycle, geopolitical risk premium, domestic infrastructure pipeline, and healthcare demographics. Malaysian equities remain attractively valued, giving us room for selective opportunities. At the portfolio level, our 3S strategy guide us. Shield, protect through diversification. Strike, beyond identifying mispriced assets, we also take tactical positions. And squat, stay patient and disciplined through volatility. This framework allows us to navigate uncertainty confidently while staying positioned to capture long-term opportunities. Investors should watch a few key signals in the months ahead. First, global interest rate. How fast central banks cut rates or delay easing if inflation stays high will drive liquidities and risk appetite. Second, geopolitical development. History shows wars and conflict create short-term disruption. Life and business eventually adapt and normalize. People move on, market adjusts, and economy continues. Third, inflation remains critical. Persistent inflation means tighter policy, which affects both equity and bonds. Fourth, the AI investment cycle. If momentum slows, valuations in tech sectors may adjust. Finally, capital flows into emerging markets. In Malaysia, foreign ownership is relatively low, so even modest inflows could meaningfully support the market. Overall, it is less about predicting every short-term move and more about staying diversified, disciplined, and focused on high-quality assets with strong fundamentals.